Okay, I think everybody has registered and is in, and we are live today. So my name's Jeff Clark with Baker Real Estate, and I want to thank you all for joining us this morning on what is going to be a very special and informative Zoom meeting. I apologize in this new world for having to wake everybody up so early. I know that pretty much everybody now has their alarm set for the crack of noon, and we've got you up a little earlier than that today. But that's the new reality, just as the new reality is me wearing red and white checkered pajamas with a blue dress shirt. So we're adjusting to everything nicely, but we really do appreciate everybody joining today. It is, as I said, a very special Zoom presentation, and we're really excited about it. We have a very special guest Barbara's going to introduce in a minute, but I would like to take this time to first say this is a webinar, so if you look down at the bottom of your screen, you'll see a little box that says Q&A. So we're happy to take some questions. If you would like to text those questions to the Q&A box at the end. We'll pose them to our guest or Barbara, but in the meantime, I'm going to introduce our illustrious guest, our illustrious president and CEO. We all know her, Barbara Lawler, and I'm going to pass it over to her.
Thank you, Jeff, and good morning, everybody. Thank you so much for joining us. It goes without saying that the past 6 weeks have brought challenges and changes that none of us could have foreseen in our lifetime. Our collective response as an industry in the face of acute turmoil and pressure has been nothing short of remarkable. We've gone from shaking hands and face-to-face encounters to make sales, to rethinking our business model, to respect social distancing and everyone's health. Virtual has become an important word. In fact, it probably is the operative word for the foreseeable near future. Over the past few weeks at Baker Real Estate, we have been exploring new ways to do business with buyers. We've developed virtual presentations at our sales centers, and these meetings are live, interactive, salesperson to client, salesperson to broker. And it's a very interactive experience. And we've been selling with virtual presentations, and they're working. We have been actively selling every day across the GTA, everything from $800 per square foot to over $1,700 per square foot. We recently firmed up a $2 million penthouse in a building that will not be ready for occupancy for 5 years. We also wrote a $1.6 million deal at a building that is just approaching occupancy. So we've been writing deals every single day. And that is one of the most surprising aspects of COVID-19 for me. I was selling new construction condominiums in the 08-09 banking crisis. And we were just stopped dead in our tracks for several months, whereas we are continuing to sell during COVID. I believe this is greatly due to the participation and support of our developers, our industry leaders, and our Baker Realty partners who haven't missed a beat. We've been presenting to brokerages, to individuals, to agents with their clients, and we're very encouraged with the results. Definitely the beginning of a new chapter for our industry in the digital age. I don't doubt that there will be established strong fundamentals that will carry forward when the market allows. But we are adding new ways of doing business that will survive the pandemic, and that's exciting. The new condominium sales industry across the GTA in March was up 108% over March of 2019 and 30% over our 10-year average. In fact, it was the strongest March in our industry's history. We were in a demand exceeding supply, a really strong demand exceeding supply market. And with remaining inventory continuing to dwindle, I think we'll find ourselves with pent-up demand when we reopen our presentation centers, hopefully soon. They say you can't keep a great industry down, and history has shown us that real estate has always been a prime lifter of the economy after a crisis. It was after the 08-09 banking crisis, even after the Great Depression, it was the first-time buyers and the home consumers that brought the economy back. I'm hearing and taking part in conversations that our immigration will slow, and we've been depending on immigration for our investors. But immigration has not stopped for those who have gone through the long haul of documenting and getting approved. It's a very long process, so that has not stopped. And it's not quite the same thing as border crossing issues, which are temporary. If anything, Canada will be more important or more attractive to future immigrants after COVID because of the exemplary fashion that we've handled things during the crisis. I'm also hearing conversations and taking part in conversations about unemployment, and that's a great concern. But our numbers of unemployment are low, historically low. They are in the mid 6%, and I mean, that may grow a little before we recover, but it does mean that the other 93 or 94% are gainfully employed. And I've always believed that you can't recover without the right people in the right jobs. So I do feel that we will be rehiring the right people to do the right jobs when the time is right. And also our low interest rates will make us very hard to resist. And there will be competition amongst our lenders for business. I had a really interesting conversation with one of our Peerage Realty partners in the US yesterday, where the governor had just lifted the lockdown and allowed people to go back to work. And he told me that in the first 24 hours, their MLS listings skyrocketed to break all previous records. And this tells me that people are having real estate conversations across their dinner tables during the lockdown, and they're making commitments and decisions to change, to move, to invest. And this will contribute to the pent-up demand when the green light goes on. These are some of my thoughts from the front line, but today we are truly excited to have our keynote speaker, Stephen Burke, join us from New York. Stephen is a managing partner at ARS Investment Partners, and I had the good fortune of seeing his presentation, and I do believe you're going to find it fascinating. So at this point, I'll hand it over to Stephen. Stephen, welcome, and thank you for joining us.
Thank you, Barbara. And let me get started here. Thank you very much, and thank you, Jeff, for allowing me to join your call today. The global pandemic is impacting all aspects of our lives, and we believe the consequences will be felt for decades. And it's going to change not only how we live and learn and work, but also how we govern around the world. The virus has exposed, unfortunately, many of the economic, political, and social vulnerabilities that have built up since the '08 financial crisis and will have been building up in the system for some time. Unfortunately, it also highlighted just how unprepared the US and other countries were to deal with pandemics, something that will be more on people's minds going forward. You can't have these kind of meetings without talking about the loss of lives and the emotional and financial damage from the lost jobs and lost wages of so many. But as Barbara said, we do believe there's another side that we'll come out on, and we'll come out of this stronger, and it may take a little bit longer than anyone would like, but we're quite positive on the other side being quite positive for both the US and Canada, as well as the overall global economy. One of the great investors I follow had a line about what we're going through right now. He said, if you're experiencing something that never happened before, you simply cannot say how it's going to turn out. So what you're going to hear from this point forward is our best thoughts on and our highest convictions on how we see the world playing out and where we're actually investing client money as a result. So this is not an economic discussion, but a practical one from an investment firm in how we're allocating capital for clients. So let me get started. There we go. So I want to cover 4 topics today. Take a look at the pre-pandemic environment, discuss some important demographic trends that are impacting both government and businesses, and I think have some significant implications for the real estate area. I also want to address the monetary and fiscal policy issues, because a big part of what we do stems from our outlook for interest rates, inflation, and corporate profits, which are very, critical drivers to how the global economy plays out. And then last, I want to share some thoughts on what the post-pandemic world looks like. But just to give you a little bit of background, I started in the business in 1981. I was rejected from a job selling commercial real estate for Helmsley Spear because I didn't understand that 10-year treasuries at 15%, prime lending rate of over 20 was not a good opportunity for me to sell real estate. So I ended up going to the investment business where money markets were 21% and started my career at that point. I joined ARS in 2007 and became the managing partner in 2010. We're a $1 billion manager, and we manage for institutions and high net worth individuals. One of the things that we focus on as part of our investment process is every day we try and do 4 things. Define the global economy and where capital is going to flow, identify undervalued sectors, industries, and companies that are going to benefit, build portfolios around the client's specific needs, and importantly, manage risk throughout the process. So what you're going to hear is the views of where we're applying capital today and what the drivers are for that. But let's start by looking at the 10 largest economies in the world coming into 2020. And this is an important kind of assessment because it tells you where we were and where we're going. Coming into the year, we didn't see a recession coming into the United States for at least till the end of 2021. Obviously, that's all changed with the pandemic, but you had a very strong US economy for a number of reasons that we think were critical. You also had China coming out of a difficult period where they were forcing a slowdown internally to manage their risks, but then we're in the process of dealing with trade issues. But because of all the work that was done, they were starting to come back. Japan's been problematic for a long time, as you can see by their growth rate of 0.47%. But importantly for Japan, they had another big issue. Their demographics are going the wrong way. So when you think about GDP growth, you think about productivity and population growth. Japan has had some pretty good, okay productivity, but terrible population issues. Right now, last year they lost on a net basis over 500,000 lives. So they're seeing a decline, and they're projected to go from 125 million people in 2020 down to about 107 over the next 15 to 20 years. That's a very difficult challenge to grow your economy. And if you look at many of the European nations, they're facing similar issues. So Germany, which is the economic engine of Europe, growing at 1.25%, is getting a kind of a triple whammy. Auto sales are down, trade is down, and they're having problems inside the EU. So dealing with that is a problem. And then Angela Merkel, who did what we think a very smart thing of going early and trying to take immigrants from the war-torn areas, particularly Syria, into their country. When they went early, it was politically very unpopular, but she probably got the best of the people immigrating. To get from Syria to Germany is not an easy task. So she got a lot of doctors and scientists and engineers who could get there, but it was very poorly received. But Germany's struggling with their population growth and politics right now, as well as the bed and flood structure of the European Union, which doesn't allow a fiscal union. It only has a monetary one. India is probably the biggest growth area and a great emerging middle class, but they also have their political issues. The UK with Brexit has put them in a tough spot, although they're coming out of it. France is actually doing some very interesting things from a technology perspective. And then you have Canada, which actually is our second favorite market for two reasons. One is the innovation that's going on in tech hubs like Toronto, Vancouver, and even Montreal is actually positioning for the next future technology, which I think is going to put Canada in very good standing and shifting the economic outlook from the traditional banking and oil and other natural resources back into a period where you're moving into high tech, which is very important. The second area, and Barbara mentioned this, is immigration. Your immigration policy is actually quite good. The US policy is quite bad. So to put it in perspective, in Canada, you let basically between 300,000 and 400,000 immigrants come in, with a high portion of them what we would call skilled labor. In the US, we cap our skilled labor, which is our H-1B1 visas. We cap them at 85,000. You're letting in maybe 3 times that for a country that's a little more than 1/10 the population. So very good immigration policies actually help with your growth rate. And I think you're becoming a much more productive system because of some of the new technology in other areas. And you're making the adjustment from kind of your old economy to a newer economy outlook. But clearly we're going to struggle with growth around the globe for those reasons that you have trade ceasing for some period of time, but you also have other dynamics, which we'll get into in a minute. So forget the $90 trillion global GDP for this year. We'll be back around 3 or 4% less than that, I think, overall. So instead of having 3.4% growth, we're going to go the other way. Before I leave this slide, the other important part of this slide is the problem with debt to GDP, which is rising all over the world. It's a problem long-term, but it's a necessary evil for the short term. When you shut down economies like we're going through right now, an engineered recession that we're experiencing, you're going to have to support the system. And that's going to require that the debt to GDP in all these nations is going to go up. And governments have really ratcheted up, which we'll talk about in a minute. Barbara also touched on the employment rates, which are in the US skyrocketing. So we've had over 26 million job losses since in the last month, which is more jobs than were created since '09 in the US. Europe announced today that they've seen about 40 million job losses already. A lot of these will be temporary, but some of them won't be. And one of the challenges we had coming into this was a skills gap versus the skills required for the new high-paying jobs and the skills gap that the workforce had. And that's an educational issue, which we'll touch on in a minute. But all these numbers are going to go up in the near term. And we think they will come down pretty rapidly once we get to reopenings, if we reopen in a good fashion, which is not too fast and not too slow. But when you see the numbers in the per capita GDPs, the issues are going to become clear as to who wins and who loses in this environment. And we think that on a country basis, it'll still be primarily a 2-horse race between the US and China. We think Europe is going to be struggling. India will have fits and starts from a political perspective. We like the demographic profile and the economic profile of Canada. One of the big concerns with Europe is a very weak banking system. One of the strengths of the US and Canada is our banks are much better capitalized than most of the rest of the world. We worry with China down the road that their debt and demographics are also not going to be favorable for them. So that's going to be a positive engine in the near term, but become a bigger problem in the longer term. So let me just shift to the response that governments have had. Monetary policy and fiscal policy response has been swift, aggressive, and unprecedented. Taking lessons from the '08 crisis, we've actually put around the world 18% of global GDP in stimulus programs for monetary and fiscal stimulus. I think stimulus is not exactly the right word because we're only trying to slow down the decline and replace lost wages and stop job closings from being permanent. But it is a very impressive response. I think Canada actually did some very interesting things about how they're supporting the workers and firms so that they don't have the big drop off. The US, we were slower to respond than we should be. And I think we're going to continue to put more money to it. But our initial policy response from a monetary and fiscal perspective is 30% of GDP. That's unprecedented. That's higher than what we've seen in even after World War II. What we will expect, though, is that this is only the initial stages, that these are all defensive plays that the central banks are doing and that the governments are doing. To get a restart going, and an effective restart is going to take some time, and we think it's going to require an awful lot of money, which has longer term implications. So I want to shift to demographics because I talked about how Europe and Japan and China are struggling with their demographic profiles. But what's interesting is the implications of this for healthcare and for employment and for government regulation, particularly around pension plans as well. But this top chart shows what the potential worker ratios or support ratios were for the elderly. So it takes ages from 20 to 64 and compares them, how many of those level workers people do you have against people over 65? And in 1950, it was 10 to 1. It's now in 6.3 to 1 workers to retirees, on its way to 3.5 to 1. Those are bad numbers. And to put it in perspective, how it flows through to other areas, take one of the big Canadian pension plans, and I think it's OMERS, but don't quote me on that. They have about 330,000 members. They did a study of what the demographics profile change was from 1990 to 2016. And what they showed was that workers would work in the system in 1990 for 29 years. By 2016, it was down to 25 years. And people taking benefits went from 25 years to 32 years. So you have fewer people paying into the system for a shorter period of time and more people taking benefits for a longer period of time. That's bad pension math. And we have a similar problem in the US where you have these strains that are going to come on the pension systems to get higher returns in a time when that's going to be harder to come by. If you look at the lower part of the chart, it breaks down what the population was by age groups. And what's important that you can see is the decline in the 0 to 14 has been steady from 1950 to 2019 and continues to ratchet down. And look at the longevity as that changes for 60 plus, 8 going up to 21% of the global population. So when you think about the aging, the strains that that's going to put on governments, it also has implications for how we live too. Barbara and I were talking yesterday, in the US, we have a terrible problem with the coronavirus in nursing homes and how that's going to change how people think about nursing homes going forward and how nursing homes are developed. That's just one element of it. But the needs for healthcare and the shifts in healthcare are very much driven by demographics as well as economic prosperity. So you have to look at all these factors together and decide what the economic implications are. It's a very interesting dynamic. So I want to just shift gears to a study that was done by the San Francisco Federal Reserve. It was a working paper that worked its way into the Fed Board of Governors to set their policy. And they looked at the longer run economic consequences of past pandemics, going back to the Black Death in 1347. And what they looked at was all pandemics that had over 100,000 people die. And one of the elements that they had to do is to focus on the implications for interest rates and inflation out of Europe to give some kind of signal for what we might see going forward. What surprised me when I looked at the chart and a cautionary tale for the reopening is in very few cases was it limited to 1 year, the pandemic problem. And that actually gets to some issues that we're going to have to focus on. But actually, if you go back to the Black Death, it was viewed to have started in Asia and came to Europe through shipping in the Middle East. So the traders came in and the ships came in. What happened was where it really hit in Europe was in Sicily, in the port town of Messina, where several ships came in and half the sailors were dead and the other half were really sick, which is about the time that they came up with the concept of quarantines, where the sailors, when new ships came into port, would be there on board for 30 to 40 days before they were allowed off, just to deal with the diseases that came through. Also in my research, just as an aside, they think that the song Ring Around the Rosie came out of this because what happened was when people got the Black Death, they would actually, it would hit them so fast that in 24 hours they could be fine, and then they would all fall down. And that's where they think the nursery rhyme came from, that Black Death period. Moving on to what the economic impacts of these are, take a look at the Spanish flu, where from that, they think that for a 20-year period, they studied all these, the Fed did, studied all these periods and looked at inflation and interest rates for that 20-year period or longer. And what they found was that inflation rates would drop from pre-pandemic levels. They would drop about 150 basis points, or 1.5% after 20 years, and then plateau there and stay low for up to 40 years, 4 decades of lower interest rates following pandemics historically. Add to that they found that in those times they did have a spike in wages, but part of that was because the average life expectancy for most of these that are predate the 1900s was only 40 years. It was 30 to 40 years in most populations. So when you had a pandemic hit, you wiped out a lot of your labor force. Now we don't have that problem. So our expectation coming out of this will be a little different. The other thing is they point out around the Black Death was that in England, they saw that wages spiked 100% over the couple-year period because so much of the labor force was wiped out. But the real return on real assets was down between 5 and 8% for an extended period. So the dynamics of coming out of pandemics are lower interest rates, pockets of inflation would pick up, particularly around wages, and that real rates of return were lower for an extended period. I think we have a slightly different take on what's going to happen coming out of this. We think there will be some pockets of inflation, but more deflationary pressures. That's a result of the following areas. So as we look at the lessons, we think that you'll have a low return on assets overall. Interest rates will stay down for decades. Wages may gradually increase, but there'll be labor shortages in key areas. When we look at the low return on assets, we do think inside there, you're going to see some very well-defined beneficiaries. And as we look at the broader economy, what's going to drive the economy and what's driving most economies right now is technology advances and also healthcare spend. We think those will still remain key areas. We think defense will be a big area of spending, and defense is not just your traditional armaments, but also around cybersecurity and defense against bio-attacks as well. So you have a very different look of what's going to matter for governments and for businesses. We think the job rebound may be robust, but wages will not match the job rebound. We think that there'll be little or no inflation due to those 4 areas that are listed on the screen. Technology obviously is a big deflationary force. Demographics continue to weigh on the system because as we age, the spending patterns change. Debt, both student debt has been a big problem in the US, but also government debt and household debt. What is interesting, and this is a big help for the US economy, is that household debt as a percentage of GDP dropped from 136% in 08 down to 95% today. So we come into this pandemic with a much better household profile. Unfortunately, corporate debt rose dramatically during that period. And we're now on our way to deficits rising in the US from $1 trillion to $3 or $4 trillion Again, the debt and deficit problems for the US will have to be addressed, and other countries at a later date. So I want to just shift to some quick thoughts on the post-pandemic landscape. US consumer savings have been on the rise. We came into the '08 crisis where we were saving less than 5%. Since then, we've moved up to about 6 to 8% of savings rates. And I think we'll be moving up to 8 to 10% coming out of this, which has a bad dynamic, which is called the paradox of thrift, which is when people are saving, they're not spending, which creates a ripple effect through the system. I do think that one of the things that'll change is that a lot of our millennials who are renting will start to shift more into real estate. I think that may be a more global phenomenon as well. Remote work becomes a more permanent part of this system for many, which means your household or where your primary living quarters are will require more space, including an office for a lot of people. We think the education system will have to undergo a significant transformation, and leisure is going to change where people are not going to be traveling internationally as much in the early stages. That we think that has some implications. For businesses, the big implication is global supply chains are going to change. They're going to change for two things: to be more self-dependent, which I think means that will require greater cooperation between the US, Canada, and Mexico to have more resilient supply chains, not only for business, but for the government as well. And you're seeing that in healthcare right now. We think the remote work could change office space requirements for companies where they may look to have between 30 and 40% fewer people in the office. In other areas that might not change as much, but that has implications as well. And health safety becomes a whole new consideration for offices and how we work, and that's going to have big implications for us. Debt and deficits will continue to rise for governments. In the US, the bailouts will require government to be more involved in certain industries, which will be an uncomfortable feeling for those industries. But it will also shift the dialogue between government and business. I think in most all countries that you're going to have more public-private partnerships to deal with some of the issues we're facing. Investments in infrastructure can no longer be postponed in the US. I think Canada is ahead of the US in how they deal with infrastructure issues, but globally it's a significant problem. And I think every country needs to adjust their infrastructure, and not just physical, but we view infrastructure in multiple ways, which I'll touch on in a minute. The crisis is going to cause required changes in tax structure. We think government's going to have to increase taxes, but in the longer term, initially they won't be able to do that, but they can close up significant loopholes. And we think that this is going to change the global landscape for alliances between nations for economic and geopolitical reasons, where you're going to have a China-Eurasia-centric group and a US-European group, and Russia could be the swing vote. So I want to just finish and take questions with a couple issues. The growing big issues I think that are going to have to be addressed by all countries are the growing income inequality and its root causes, debt and deficits, and shifting leadership and the relationships. We think that inequality has several root causes. One is technology and education combined. The way tech is changing requires higher skills, and if you don't have a good education system, you're having a mismatch between what education is training people for and the skills that are needed. We think that's been a big cause. The scarcity of skilled labor for technology and healthcare creates an inequality because you have supply shortages which raise wages. And in manufacturing, when we had globalization, you were moving away to lower cost areas. We think the onshoring will help with the manufacturing areas come back, but it won't deal with all the inequality issues. We think debt and deficits are going to weigh very heavily on countries. It's going to lead to very important decisions on how you tax and how you govern and how you deal with that. We think it's a problem for a later date. But importantly, we think that the shift in global leadership is going to have some big implications. And a lot of that is around technology and the fight between between the US and China on technology, starting with 5G. Canada got drawn into it with the arrest of the Huawei CFO. But China would like to have a standard for the internet and has proposed this in the last year, that the internets are governed by the governments, not by companies, and you see a very interesting dynamic between the two of whether you have a more Western model or a more government-driven model. And that's just the start of some of the philosophical and political differences that are going to play out for countries around the world as we go forward. So a lot going on. I've probably run over a little bit long, but I'll, Barbara, if you'd like, or Jeff, I'll kick it back to you for questions.
Yeah.
That's great, Stephen. That was really, really good. And the questions are coming in. I just had a quick question. We touched on it yesterday. You described this as an engineered recession compared to the financial meltdown that we all lived through in 2008, which is more systemic. How do you see the differences in the recovery between the two? Are they going to be the same, or I feel like this might be more protracted, but just interested in your opinion on that.
Well, as I started, there is no historical precedent for what we're going through. There was one for the financial crisis, which was a crisis in the banking system and liquidity. And the answer for that they found was to recapitalize banks that needed to be recapitalized, shore up the regulations and deal with that. And they could put money to it and make it work. The problem right now, and Jeff, as we talked about, from World War II to up to that financial crisis, you had excess supply, excess demand, and inflationary pressures that were in the system. From 2008 to today, you've had excess supply and deflationary pressures from globalization, technology, debt, and demographics that we touched on. Now you have a forced shutdown of business activity, which wasn't the problem the last time. The problem was where the market's functioning and were you allowed to have capital move. This has stopped that. This is a supply and demand destruction that's been forced on by governments to put health ahead of spending, production, and growth. So it's a very different dynamic. So once you start opening up, as you're starting to see in certain states around and certain countries, you're going to see economic activity start to return to whatever normal will be for each industry. And one of the important points we'd make around that is for some industries and for some companies, this will be a slowdown because it's not long-term and it's just your buyers weren't allowed to go out and buy and they'll be back buying. For others, it'll be a recession, and the severity of the recession will depend on your business. And for some, quite frankly, and unfortunately, it's going to be a depression. And whether those businesses survive or can come back will be determined by the change in consumer and government and business behavior and how those industries are looked at. The travel industry is one that's going to have to undergo a pretty significant transformation. The airlines industries, retail stores, all those things are going to be tested, but it's a very different dynamic when you think about governments stopping activity versus a financial crisis.
Right. I have another question here. Bear with me as I read it. Stephen, do you see a rise in asset inflation due to the government stimulus packages? I know you touched on it on slide 8, where you said little to no inflation. I missed that part. Can you repeat that slide specifically? What do you think about asset inflation?
Well, actually, that's the irony of what's happened since 2008 is to deal with the debt problem, we threw a lot of debt at the system, and that was designed to inflate assets to defease the debts. So assets will inflate to the extent that we keep throwing money at the problem, but we don't see real inflation coming. So it's an interesting dynamic, which that actually feeds into the income inequality problem, because those with assets have benefited for the last decade and exacerbated income inequality because their assets were inflated because of the economics of monetization. But we see that that continuing for as long as we can sustain it, which is kind of the dice game that central banks are playing. Because at some point, if the debts get so unsustainable that you can't support your debt costs, then you will have a reversal of that. But for the near term, we definitely see asset inflation as a outcome of this because it's part of the design, which creates other moral hazards as well.
Right. Well, I see a lot more questions here. Hopefully you can bear with us. I actually have one for Barbara from Stuart Wilson at Altera. Barbara, he said, are you concerned that the record US MLS listings you talked about in one state is more of an indicator of an economic downturn and the need to sell assets than an indicator of the return of a healthy real estate investment market? Was there any feedback on the actual sales numbers?
This just happened, Jeff, in the last 24 hours. So the result of this allowing people to go back to work, we don't know the results of it yet. Certainly, I would think that listening to the conversations I've had, that people have been pressing and pushing to get on with their lives and their real estate decisions and have wanted to buy and clearly have not been affected with employment losses and money losses. And they have been pressing hard on these real estate companies to get back into the market and to get on with the plans they had before the COVID. So he did say to me that he is not seeing on the MLS listings a shift in value, in price. And perhaps, I mean, once this initial rush is over, perhaps things will settle a little differently in the short term. But the general feeling was that price was holding, and it was a response to pent up demand getting to open its doors. So we'll see.
Yeah, we'll see. I have another question here for you, Stephen. You'd mentioned that you believe that millennials and additional buyers will look towards real estate investments. Coming out of this, do you see this putting an upward pressure on real estate pricing?
I think there's going to be shifts in you have two dynamics going on in our view of the older population shifting into different types of housing and the younger population shifting from rent to own. So it's going to depend on how those shifts are sequenced. And where the supplies are in each market. But in general, we just see it as a normal shift. I think one of the differences between going forward for the millennials and what we've seen a lot over the last 20 years is it's going back to your house being your most valuable asset more than something you trade in and out of for speculation, which I think was a big part of it. We have to remember that a good part of the 20 and 30-year-olds have been greatly scarred by now two crises, the pandemic and the 2008 financial crisis, particularly in the US for housing. So I think there's some different dynamics at play in different countries. But in general, we think that it depends on how that shift goes and how the demographics actually plays out in each area.
Okay, here we got another one here. For you. It's from Tony Ma. Could you talk more about global leadership shifting and what will that effect will have on our business in Canada?
You know, it's interesting. I think what should happen and what will happen are two different things. But what should happen is the two leading nations should act like leading nations, with the US and China taking a role of creating a better, more balanced world. What I think is likely to happen is that you'll have a partnership where it's convenient, but behind the scenes, the geopolitical elements will be much more divisive. Our shift is in foreign policy since the President Trump took office has been bringing the more isolationism. I think one of the elements that comes out of that is autocratic leaders misbehave with a leadership vacuum. And I think that's happening all over the world. I think as it relates to Canada, I think you're going to continue to have your economic relationship with China. And I think you'll end up having to have a stronger relationship between the US, Mexico, and Canada, so that we can be more self-reliant as a continent, and benefit better with a better protected supply chain interaction. So I think you'll see more reshoring, which is actually good for both Canada and the upper Midwest. I think you'll see manufacturing come home. You'll have some more expenses with that because supply chains aren't going to be just in time. They're going to be designed to be more resilient, and you're going to have more materials stay inside the country so that we don't have healthcare shortages and other raw material shortages that put the countries at both economic and geopolitical risk.
So sort of tailing onto that, then, apart from stockpiling certain supplies, what's your view on, do you think our incredible trend towards globalization is going to be put on ice, slow down significantly?
Well, it already started slowing down with the trade problems that the US and China had last year. I think it'll continue. I think globalization, you can't put the genie back in the bottle, but it certainly will change. There will be some decoupling, and a lot of that will depend on what leadership changes come around the world. You have, Angela Merkel is on her way out. We have an election in the US, and all our elections are really a 6 million vote difference. So they're always tight. You just never know how that's going to play out. China doesn't have to worry about leadership changes. He's president for life now. Putin was trying to make a change to keep him in power longer. That's uncertain. And then you add to it, the Middle East is kind of a mess. And that's one of the areas that we're quite worried about, because I didn't touch on oil prices and the impact on countries, but it's putting a dent in a lot of budgets, which when countries are backed up against it, certain ones lash out and you see more geopolitical conflict. So I think it's a long way of saying it's a really complicated situation that I think you'll see evolve over time. But I think the US and China will have this Cold War in technology and a warmer war in other areas that are going to play out. But tech is the big issue that's going to be very divisive, I think, in the global economy.
Just a couple of more, if that's okay. What are your thoughts on the effects of Canadian consumer debt? For every dollar earned, we owe $1.76 on average on the recovery and housing market. So what are your thoughts on our debt and the recovery of the housing market?
And I forget who it was, but there was a great Canadian investor who has a note that should be given to every kid every year in school, which is debt is the current consumption of future earnings, right? So if everyone could get that message that you're borrowing from future paychecks for whatever you're getting today, I think it'll impact, it'll have a different impact than it used to. I think for housing, I think people are going to view it more as a core asset and less for speculation. So I think when they think about debt, they're going to be smarter about how they take it on. So I think housing is one of the debts that you take on willingly, but I don't think people will be stretching for debt the way they had in the past. And I think that's going to lead to lenders, because of concerns about who can and can't pay, pushing up the required down payments. So I think you're going to see some changes in that area. But I think that people will view real estate more as a core investment and less for speculation, which I think will be a positive.
Right. Well, that's perfect, because that dovetails into a question for Barbara, and where, Barbara, you see our, how you see the condo market recovering over the next, say, between now and the end of the year.
Well, certainly our conversations and our meetings with our developers are cautiously optimistic that we will begin to to launch into the market new buildings that were supposed to launch in April and May, albeit they'll be launched differently. There will be a more virtual component to the launches. Certainly, I'm hearing that our deep investor group is a little cautious in these changes, and they're up on the fence, and they may not jump down off the fence immediately. So I think in the short term, we will see lesser response to our offerings, but I do believe that we were in an incredibly strong market when we came into this, and I do believe there will be pent-up demand left over from it. And I think by the end of the year, we will have regained a lot of our losses, yeah, I think it'll really pick up, and that we will go back, because no matter what, real estate is the biggest and the deepest investment that most of us ever make in our lives, and it is an incredibly reliable investment.
Great. Over to you, Stephen. A question about where you see our dollar and the American dollar going in the future, near future anyways.
Well, the near future, it's, the US dollar has been quite strong against the Canadian, and I think you're probably at the top end of where it will likely be in the near term, in terms of the dollar strength against the Canadian. But I don't see it going down a whole lot either. So I think we're kind of in a range right now that will be probably plus or minus around this level for a bit of time. The U.S. is the reserve currency of the world, and I think coming into this, we're in a stronger position than most. So I don't see that changing dramatically in the near term. Longer term, the dollar, and you could have a quick trade down because the dollar is a little spiky, but I think generally the dollar is going to remain relatively strong, and I think that's just going to continue to play out that way.
Okay, great. Just another question. It's more of an elaboration, and I'm not sure if it came in while you were talking about it, but just an elaboration on your comment that the millennials might be shifting towards renting rather than home ownership.
Oh, I meant away from renting to home ownership, not the other way around. If I said that, if I misspoke on that one, that's on me. I do think that one of the interesting dynamics, though, and to touch on what Barbara was mentioning, is I think there's three kind of haves and have-nots, unfortunately, three inequalities that are being exacerbated by the policies that exist. I think you have country inequality growing, that the leading countries that have the positive dynamics, and I think Canada is one of them, will continue to do well. I think that, as I mentioned, those with bad fiscal problems or an over-reliance on petroleum dollars to finance their country, like Russia and the Saudis, have real issues. I think you see the same thing with companies, big divergence in strong balance sheet growth companies versus weak balance sheet low growth companies in a low growth world. And then lastly, I think the income inequality is going to persist, if not exacerbated, unless government policies can come in and fix that. And our way to fix that is to, in the US, to focus not just on physical infrastructure, but digital infrastructure. So we get broadband and to kids that can't have access to it now, that we have to change our educational infrastructure as well to adjust to teaching skills for the new world, not for the old world. And then lastly, you have healthcare infrastructure that has to be redone. And I think as all those things change, you're going to create new jobs. And as you create new jobs, you'll create new opportunities for millennials to become homeowners. So I think that plus the reshoring creates a different kind of market. It's a question of how fast we get to the other side and start reopening up the economy that will drive that.
Right. And when you talk about that in terms of home ownership, we have a question talking about future practices of the banks and lending, and are they more likely to tighten or loosen up considering the record low rates and higher possible default ratios?
I suspect the banks will. I worked for two banks in my career, two big banks. They always have plenty of credit for people who don't need it and not enough for those who do, particularly coming out of difficult times. I'm not current on the Canadian bank capital and debt profiles. They had been strong for a while, but I traveled to Canada when we were traveling once a month to both Montreal and Toronto. And I was always awed by how many cranes were up in those cities at all times. And I'm not sure where the banks are in their own portfolios. I think one of the things that has us viewed the US so positively is the recap of the banks that was done here following '08 has us excessively well capitalized here. I'm not sure what the status is for the Canadian banks right now, so I really can't answer that one effectively.
And speaking of cranes, Stephen, we have more cranes in Toronto than the entire US. So yeah, it's hard not to notice the number of cranes that are swinging in Toronto.
Yeah, that's an absolute for sure. Well, I think we're getting towards the end of it, and I did want to thank Stephen. I wanted to leave off with when John Paulson was questioned about real estate. John Paulson being, as for many of you know, the billionaire hedge fund manager. He was asked about real estate, and his answer was, if you don't own a home or a condo, buy one. And if you own one, buy a second. And if you own two, buy a third, and then lend money to your relatives so that they can buy in real estate. I would add that when they are buying, they should buy at a Baker site. Reasons, but that's sound advice. And I have to say this was, I personally really enjoyed this this talk and really appreciate you taking time out to come and speak with us, Stephen. For everybody, there's been a bunch of questions. I know that we couldn't get to them all. We are recording this presentation and we will send it out to you along with the slide deck itself. I think Stephen said he'd be okay with us distributing that. So
yes.
I want to thank you, Stephen, and I'll turn it over to Barbara to say final words, but I want to thank also everybody else for joining us today.
Well, you know what, Stephen, it has been an absolute pleasure. It has been fascinating, and thank you so much for sharing such a global perspective. It's wonderful to hear your thoughts, and thank you for sharing them with us. I don't know if you have any final words of wisdom, but now would be the time.
Well, it's a difficult time, but things will get better. And I think they're already starting to. Every day we're moving closer to vaccines, to testing, to tracking and the like, and even treatment. And as we get closer, it'll get the economy working again. And I think there will be some pent-up demand. I still think there'll be problems, but I think the benefits will outweigh them, and you'll have a big demand push for people to get back to normal lives. So I appreciate the opportunity to share our thoughts with you. And Jeff and Barbara, if anyone has additional questions, I'm happy to take them with you guys or arrange calls if anyone has any other questions. So thank you all for letting me share our thoughts. And with the caveat that I started with, which is since we've never been through this before, don't quote me on anything, but this is how we're managing money for clients. So we put our money where our mouth is on our views. So thank you for the time today, and thanks for letting me share.
Thank you, Stephen, and thanks everyone.
Yeah, thank you so much to our developers, our industry leaders. I know we had a group in from Montreal. We're just so delighted to have shared this with you. And I think the future looks good, it looks positive, and we may experience a wobble in the short term, but the long term looks bright for our industry. So thank you all. Have a wonderful day, and I'll see you on the front lines.